Hey team, welcome to this week's Money News in Human Words. This week, the first thing that crossed my desk was this report that's come out from AMP talking about over 1 million Australians being under severe financial stress. Essentially, AMP have done this big report and found that around 1 million workers in Australia are suffering severe financial stress, and another 2 million are experiencing moderate stress. Now, sort of no surprises, bouncing out of 2 years of COVID lockdowns and into an environment where we've got rising interest rates and inflation. The report found that financial stress has grown across all income levels in Australia. But women, single parents, and part-time workers, I suppose no surprises, are experiencing higher rates of stress. The pessimism around wage increases is also a contributing factor here. And the study pool was quite a big one. Over 2,000 people were surveyed in June of 2022. Now, over 26% of workers considered themselves in severe or moderate financial stress, which is up from 18% from the previous year. The number of women went from 19% to 27% under severe stress, and 25% of single parents admit to financial stress, up from 13% in the previous years. So those groups are impacted, but higher income earners also aren't immune. 1 in 5 workers earning over $100,000 also noted that they were suffering financial stress. So what does this mean? Well, the study found that this stress then seeps through into the economy through the form of lost motivation and productivity in the workplace and employee distraction. They call that presenteeism, is estimated to cost businesses around $66.8 billion a year, which is more than double the $30.9 billion that was estimated in 2020. So 1 in 5, 21% of Australian workers noted that financial stress had impacted their productivity, more than double the 2020 figure, and workers in financial stress are estimated to experience 12 hours a week of reduced productivity, which is a pretty crazy stat based on a 40-hour work week. So some scary stats there. The article went on to talk about what to do if you're facing financial stress, and sort of common sense, but probably worth noting for anyone that's in that position. Look at your spending. So what money's coming in, what money's going out, and what's left over. Make sure that that's solid. And my tip on that is to make sure that you're prioritizing the things that are the very most important to you and deprioritizing the rest. Looking at debt, and any debt that you've got, making sure that you're not paying more than you need to in interest costs, looking to refinance. Super competitive markets out there in the debt space at the moment. So I think that makes a lot of sense. You speak to a good broker or bank, or do your research online. There's a lot of great comparison sites these days. And then the third one was to seek out professional financial help, either financial advice, guidance, or if you're in struggling with debt, there's financial counseling services that are free of charge and available to people around the country as well. The next piece that came across my desk last week was around the economy in Australia is still growing, but being tipped not to last. Now, growth is surging in Australia at the moment, with economic growth coming in at 9% for the quarter, lifting the annual GDP growth, so gross domestic product, so the total output of the economy, from 3.3 to 3.6%. At the same time, the economy's entered the most aggressive rate hiking cycle in 3 decades. With basically, thankfully they've done that from a strong position where we've got these raising commodity prices that have pushed up the this figure they call nominal GDP growth, so nominal gross domestic product growth, to 12.1%, which is the highest level in almost 40 years. Overall, the economy is now 4.4% bigger than it was pre-pandemic. And that's an interesting one to think about, because prior to the pandemic, the economy was growing really strongly. The share market was surging, property market had softened, but then starting to rebound. And so seeing that we're now at a level above that says really good things. But with the interest rate hikes in particular, the RBA and the experts are predicting that the economic growth is going to slow as these higher rates filter through the economy and force households to cut back after some serious spending growth over the last couple of years. Look, my take is how accurate these forecasts are is really anyone's guess, but given their recent track record, some might think that they might just be throwing darts in the air and thinking of what might happen. I suppose time will tell on that one, but we have seen this growth fueled by strong consumption from households, which has increased even in June and 6% now higher over the year. Spending out on clothes, shoes, footwear, that sort of stuff, it has also increased. So the savings ratio in Australia has declined by 8.7%, which is sort of makes a lot of sense given that we've not seen wages growing. In fact, wages are growing backwards in real terms. Interest rates are up, so the cost of interest costs are up. But the economic growth is still growing, which means that money needs to come from savings. So how that plays out over the next little bit is going to be crucial to how much the RBA needs to do on rising interest rates and what that actually means for the economy. And talking of RBA, another quick piece I saw last week was around the RBA linking interest rates to wage growth. They said that rates need to keep going up, but that they're going to be largely driven by the data. And they said that if people should be prepared to take real wage cuts because, and I quote, that the alternative is much worse. They're basically saying that if wages keep growing and growing strongly, it's going to put more money in people's pockets that can deal more with inflation. They're going to be able to keep spending more. The RBA is going to have to increase interest rates further. I'm guessing that nobody really wants to take a real pay cut, but they're saying that that's probably the best thing from them not needing to raise interest rates as much. In the US at the moment, we're seeing like 5% real wage growth. But basically, the RBA is saying that if that happens here, our chances of avoiding a massive tightening of interest rates and the resulting high unemployment is going to be significantly lower. So a little bit scary, a little bit sad in that we might need to be taking real wages cuts to avoid high unemployment. But yeah, definitely one of the most crucial areas for the economy and for individuals and investors over the next little while. Changing gears a little bit, I was looking last week about Aware Super. So one of the biggest super funds in the country, they've got about $155 billion under management that they're basically making a $7 billion property play in the build to rent space. So this build to rent is basically where companies build massive apartment buildings and then rent those out. So they're making a play into the residential property market, but doing it through big buildings where they've got a medium to longer term time horizon where they'll get the income yields from the rents and then the exposure to the property market. Now, Aware Super in particular has been working on essential worker build to rent accommodation since 2018. Before it was spoken about and before the dawn of superannuation, Paul Keating came out recently talking about how super funds should be working and things like affordable housing and infrastructure in the country. Essentially, with this essential worker accommodation that they're talking about building to rent for teachers and nurses, where they say that essential workers are a little bit more immune from economic downturns. We saw that through COVID, that they're being strongly in demand. So for them, it creates some certainty around the income and rental from these property investments for them. And they're looking to build. They've got 500 rental apartments in their portfolio and another 1,200 in the pipeline to come online in the coming years. Now, more build to rent is coming, and it sounds like a smart play. It seems likely that based on the size and scope of this investment from Aware, obviously the numbers are stacking up. So my view is that we're probably going to see more players entering this market over the next little while. What I think that means then for property prices and the property market around the country is that it further supports property prices and has the impact of increasing density, which helps anyone that's in a lower density property. Now, we're big believers when you buy a property to try to buy, if you can buy a house because you get more land. If you're going to buy an apartment, buy it in a smaller block because then you've got smaller, more land exposure through a smaller block. But as we get more and more of these bigger buildings, which these build to rent options typically are, then that pushes up value on property prices. And I think the more we see of this, the more it's going to benefit current property investors and anyone getting in over the shorter term. Talking company reporting season now, and we have seen a lot of companies that have reported their earnings data over the last little while. More than 40% of the companies that have reported their earnings data over the last little bit has surprised to the upside, and less than 30% have come in under forecast. Around a third were in line. So the future expectations for for company profits and their profit growth remain elevated, while at the moment at least. But they're talking about the fact that these earnings forecasts can be slashed pretty significantly over the next little while based on what's going on in the broader economy as well. But what we can see at the moment is companies are still performing well. What that means for investors is we've seen the share market values come off, but with these companies still churning out significant profits and significant dividends, then investors are still somewhat protected from this downturn. So I think there's an interesting lesson there. My last piece for this week is about Queensland's horrific property tax, in my opinion. They basically came out and said that they're going to tax Queensland property owners and investors on the land value of their properties in other states, even if they are already getting taxed in those states, essentially. So basically, along with sky high inflation, raising interest rates, and real wage growth, for people that unfortunately get stung by this tax, they could be needing to fund thousands of dollars in extra tax every year. Now, these changes apply from June of next year. They're based in Queensland, but apply to property around the country. Essentially, one of the case studies on the Queensland government website, and you can check out all the details on there. It's actually pretty easy to digest, that they talk about property tax increasing from some property owners from $2,000 or under $2,000 a year to over $8,000 a year, essentially taxing you on the value of land that you've got in other states, where in the past, if you own a property in Queensland, a property in New South Wales, a property in Victoria, for example, because each property is under the land tax thresholds in each of the states, you essentially don't pay property tax. Whereas now, Queensland are looking at the total value of all of your land, adding up the taxes if you pay, and then applying that to the Queensland portion of your property, which to me, and a bit of commentary from people talking about, people that own this many properties they can afford the tax, so why shouldn't they pay? But in my view, the rules were already in place, and they've applied these rules retrospectively to property owners. So I think if you've made your property investment decisions based on the current rules, and then they change the rules, and as a result, you're having to fund all of these extra costs and wear that, it seems really punitive and unfair, because we're big believers when we plan property purchases that you look at all the expenses, you make sure that the decision stacks up, and then you can have confidence in your investment. Whereas now the goalposts have significantly changed. Now, they talk about the fact that you've got a bit of time to review your property portfolio, but with the soft property market, if you realize that you probably don't want to own that property in Queensland anymore, you may have to sell at a loss, or in not for the ideal price that you want from that property, which again is pretty harsh for property investors. Given that it's just been announced, it seems pretty unlikely that the property tax will be overturned prior to it kicking in next year. However, there are a number of groups that are petitioning the government to do exactly that. So in my view, fingers crossed that they get that one over the line. Seems pretty crazy, and it could significantly impact your property purchase. For anyone that owns property in Queensland, you want to understand the rule changes and how they apply to you. For any property investors or would-be potential property investors, you want to really understand the impact so that you can see how it's going to apply for you, and make sure that you're prepared so that you're going to be able to fund that tax if it is something that applies to you. Guys, that's it from me for this week. I will catch you on the next one.